So housing prices will move sideways. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of coffee and let's check out this article from Westpac IQ looking at some predictions for house prices, everyone. So here we go. It's prediction time from the banks. What do you reckon? So Australia's housing correction is largely over. So there we go, guys. According to Westpac, the correction is largely over. We've had the crash. The crash is done. I mean, wouldn't it suck if you're there sitting there waiting, expecting a huge correction? I mean, how many years are people going to wait for a correction? And think of the opportunity costs associated with that. It's getting more and more expensive now as rent's going up. You got to love Australia, don't you? Several factors combining to produce a stabilization. That said, markets will remain on edge near term. Prices expected to hold flat this year, with a sustained recovery only coming in 2024. Inflation risks are key. Okay, so a few caveats to their assumptions and arguments here. So nationally, dwelling prices to hold flat in 2023, revised up from a 7% fall. So, wow. Prices are now expected to lift 5% in 2024, revised up from plus 2%. Market is showing convincing signs of stabilization. Migration influx, there you go. Increased cost of new builds, there we go. Tightening supply are contributing factors. Tightening supply, as I call it, the construction apocalypse as well. Oh boy. There's still significant headwinds, but improving outlook for rates and prices will provide support. Sustained price gains to emerge once the rate cut cycle begins in 2024. So Australia's housing sector, these are the positive signs, experienced a material correction in 2022 with rapid rate rises driving significant declines in both prices, 9.7% between April 22 and January 23, and turnover down about 30% over the same period. Because people don't need to sell. People were only selling because it was nuts. In the mania. Oh boy. I think a lot of young people are going to realize that regardless of which mob you have at the top, Labor or the coalition, it's the same for housing. You're pretty much screwed, honestly. There's no political will for a significant correction in house prices to drive affordability. I can't see it. More recently, markets have shown signs of stabilization. Prices nationally held flat in February, posted a 0.8% gain in March, and are tracking a similar gain for April based on daily figures for the month to date. While the detail shows gains are still lopsided, centered on Sydney, where upper tier markets are leading the way, and seasonal boosts are flattening the situation a little, all major capital cities will now see prices stabilize or post small rises over the last 3 months, or have now seen prices stabilize. I mean, let's bring up my city here. Let's look at asking prices in Brisbane from SQM, guys. I mean, there you go. It's just nuts. Look at this. Look, how far back are we going? Hang on, let me zoom in so I can see this. For me to actually see what you guys are seeing, I need to change a few settings. So if we have a look here, 2021, all houses, 6. Now let's look at 3-bed. 3-bed is what you need to start a family, pretty much. Okay, it's a house bedroom for you and the missus, for the kids, and then the other kids. Or for us, for right now, it's me and the missus, and 2 kids, and then 4 kids in another room, and then the sister-in-law in another room. Can you tell why I'm trying to build this extension on this place? So, 580 grand in asking prices in the city of Brisbane in April 2021. If we go back to 2019, in 2019 we were talking about housing prices $500,000, 535,000. If we look down here, what are we at? 10 years, you're up 6.1%. 3 years, you're up 13.5%. So we just go up there. We can see, look, now $800,000, guys, for a median house. Even if we see a significant fall in that, in those prices, even if you got 10% off 80 grand, 20%, 160 grand, you're still going to be well off those pre-COVID levels. It really just went nuts, didn't it? Other indicators also look firmer. Auction markets show clearance rates have lifted to be back around long-term averages in April, with pre-auction withdrawals also back near long-run averages. Now, I know with the auction clearance rates, it's a bit dodgy because there's a range in the rates, okay? And it's self-reporting. So if failure real estate agents don't report their failure, you're going to get a lopsided result to the positive. And we've looked at that in previous episodes with data that people have scraped. But the reality is, if this is how they've been doing it for all time, the trend is what's important. So it's going up, it's going up. It means more people are buying at auction and more are clearing. Turnover also appears to have stabilized, and housing finance approval figures to February show a clear moderation in the pace of decline, albeit with both still at very low levels by historic standards, 25 to 30% below long-run averages when viewed as a proportion of the total number of dwellings. We can have a look. That's the summary. Let's have a look at their full report here. Hang on, let me have a shot of coffee. Okay, what are we having a look here? So it's not an interest rate driven shift. Notably, this shift has come despite official rate rises in February and March. These latest hikes follow an aggressive tightening in 2022. As such, it may be that some buyers are starting to position for the next cycle, anticipating an eventual easing in rates and resurgence in prices. Shit. I mean, could Brisbane prices, could they surge again? I mean, we've got the Olympics coming. We've got continued demand. We're still cheaper than Sydney and Melbourne. What about Adelaide? What about Perth? A viewer mentioned in the comments that he's gotten shits with NZ. He's working remote, so he's wanting to go move to Adelaide. And now we can. And good on him. Allowing the Kiwis easier access to citizenship, I think that should just be done across the board. If you're a resident for 5 years in Australia and you want to be a citizen, it should be simply tick a box or fill a form. Then you swear your allegiance to Australia. Why not? You know, they're the people that are here. You want to keep them here. Build the country up. I mean, honestly, New Zealand should just join the Federation, but I can't see that happening. It'd up our economic complexity. A country that exports cheese would up our economic complexity. Just dwell on that, guys. And it's good cheese. But anyway, back to this. However, survey measures suggest most consumers are still bracing for further rate rises near term. Responses to our Westpac Consumer Sentiment Survey question on mortgage interest rate expectations show that while views are shifting, few consumers see rate cuts as imminent. In April, only 8% of consumers expected rates to be lower in a year's time, while 75% expect them to be higher. A little over half of this group expecting a rise of over 1 point, or 1 percentage point. Let's go up here, you can see it. Housing recoveries in the past have only tended to follow through to prices once the RBA is actively cutting rates or is very clearly poised to do so. Price gains also tend to follow a sustained lift in turnover, not vice versa. 3 factors at play. Okay. Migration, construction costs, and low volumes. It is not interest rate rises then. What is driving the firming in housing markets? 3 factors stand out. The first is a strong resurgence in net migration inflows. Border reopening has seen a much bigger than expected lift in immigration, with net inflows now expected to be around 400,000 for 2022 and forecast to remain elevated at plus 350,000 in 23. And I can see here for more. No, I can't. Because we're reading the PDF, guys. We're posh. Let me know in the comments if you remember when PDFs were new. Showing your age. So, there are clear links between population growth and demand for housing, both directly through new buyers and indirectly through the impact on available rental properties and the wider physical supply-demand balance. The latest surge has contributed to a significant tightening in rental markets, with vacancy rates falling to historical lows and rents rising sharply in all major capital cities. That said, the flow-through from shifts in population growth to prices is typically quite slow and diffused. Direct demand from new migrants may impact some market segments, but typically takes time to appear and is usually not large enough to shift the wider market. Around a third of new migrants eventually end up purchasing, usually at least 6 months after arrival. Indirect effects via rental markets are also typically act slowly, the main channel being through a rise in rental yields that draws increased investor activity. So far, there is little evidence of this effect driving prices. The second factor that stands out is the sharp rise in construction costs. Nationally, the purchase cost of a newly built dwelling rose 18% in 2022, with prices for existing dwellings declining. This has significantly shifted the relativity between existing and newly built houses. In effect, the replacement cost of the non-land component of a dwelling has increased dramatically. And you also have to add on to that legislative changes. I'm planning to do a video on the changes to the National Construction Code for livability standards. That's going to add complexity and more costs. It sounds good, and you want to make houses more accessible. That's a noble cause, but it will drive up the costs. Anyway, again, through the flow-through of these sorts of shifts to dwelling prices is not often that evident. The more granular price detail suggests there may be some effects showing through in the suburban fringes of major cities, where newly built dwellings are more prevalent and more likely to affect the price of existing dwellings. However, building cost increases are unlikely to account for shifts in well-established markets. The third factor is the low level on-market supply. Despite low turnover, listings are even lower. The weak market has clearly discouraged many sellers, with both new listings and total stock on the market below average across the major capitals, albeit varying to some degree, with conditions easier in Sydney and Melbourne but extremely tight in other markets. More generally, thin market conditions mean small shifts in demand can have a bigger than usual impact on prices. It may be that a small demand lift, related, say, to population and or construction cost drivers, is seeing an exaggerated price impact due to the scarcity of properties available for sale. So the fundamentals are still not conducive to a sustained recovery. So could this be a dead cat bounce, everyone? Could it all tip over? Because there's some that are hoping it will. It's kind of sad if you're at that point, that's all you can hope for to get in. While the evidence of stabilization is now convincing, the discussion above suggests the influence of emerging positives is still limited. Meanwhile, there are still significant negatives in play. As noted, interest rates are high and expected. They're not high. The cash rate is at 3.6%, but okay, I guess it's high relative to what we've experienced recently, and expected to rise slightly further near term and remain elevated through the rest of 2023. Affordability remains poor. Poor is not the word I'd use. I'd say shithouse. Not poor. Rate rises are more than offsetting the improvements from low prices. Even with interest rate cuts next year, the affordability measures we track will still be comparable to the low point of the cycle in 2009-10. A preferred measure, which includes deposit and mortgage repayment requirements, shows the total cost of purchasing for respective first-home buyers is up 12.5% on a year ago compared to the rise we are seeing in rents. At the same time, income growth is subdued, declining in real terms and expected to remain under pressure throughout 2023. The large increase in interest rates over the last year will also see a significant rise in stress across the mortgage belt, pushing some borrowers into urgent sale situations, although this is not expected to be a material factor for wider markets, partly because the labour market is expected to remain supportive. However, the stabilisation of lower and middle-tier parts of the property market in recent months suggests affordability pressures are not weighing in the same way. More genuinely, the cumulative increase in interest rates has also not impacted prices as negatively as we had anticipated. Our previous forecast, set out in May 22 for a peak-to-trough price decline of 16%, was mainly based on what amounts to an affordability consideration. That is the extent to which borrowing capacity would be curtailed by higher interest rates. Instead, markets appear to be stabilizing after just a 10% price decline. The explanation here may be around binding borrowing capacity limits are in practice. Only around 10% of borrowers take out home loans at their maximum borrowing capacity, while most instead borrowing significantly less. And shout out to you in the comments if you've done that. Let us know. Put a thumbs up in the comments or whatever if you've borrowed significantly less than you could. I remember when we were shopping around, they said we could borrow more than we wanted to, and we didn't go. You don't go near the top because it's bullshit. You don't want a big mortgage. Maybe that's why I'm a boomer, isn't it? Anyway. Notably, average loan sizes have only declined by 5.9% from their 2022 peak, compared to a fall of around 30% in maximum borrowing capacity since the tightening cycle began. Now that's interesting. So borrowing capacity is down 30%, but loan sizes are only down just under 6%. Now that's what we don't really hear much about, is it, in the media or the doomsayers? Shifts in this actual versus potential borrowing buffer may account for the more muted price impact compared to expectations. That is, the decline in assessed borrowing capacity has been partially offset by borrowers opting for smaller buffer between their actual and potential loan sizes. Honestly, I think because we're exposed to all the bloody idiots in the media, the dad who gave his son shitloads of money to lose on a scam, or someone who's got not even a basic level of money management skills, like the sob stories, okay? Bullshit sob stories. The teacher who borrowed to buy 5 houses on interest only and then is crying because, it's all collapsing. We have fed all of that because it's the clicks. I think the average Aussie is not that stupid. It may feel like that when you're on Twitter, seeing some of the rubbish people put on there, but day to day when you talk to people out in the real world, they're not that bloody stupid. So I think a majority of Aussies out there are planning for this. They're being sensible about it. And they're not going stupid. What do you think? Am I just being naive? Or is that just the people I'm surrounded with? All that being said, though, the labour hire guy who was paying $250 a week for a room he rented in the city from his drug dealer anyway, he wasn't really that smart in his life choices, I don't think. But anyway, back to this. Oh, well, even he was arguing with some of his friends on the dole who wouldn't get off the dole because they're afraid of losing his accommodation. He said, guys, you come work here 2 days a week, you'll be getting more money than on the dole. And you can work it out with your accommodation. But they weren't interested. That's the poverty trap right there. So, no, I shouldn't criticize him. He's even a step above the people who wouldn't even take that effort. But just, moving in with the drug dealer is just stupid. You're going to waste so much money on pot that's pointless. Anyway, just wait till they legalize it, then it'll get even more expensive. They'll tax the shit out of it. Better not to partake in such silly things. Back to this. I'm going off topic and rambling as I do. Anyway, certainly the dampening effect of rate hikes on new borrowing appears to be easing. New housing finance approvals fell sharply over the second half of 22, with steady declines averaging 4% per month. That pace has abruptly slowed to negative 2.4% in January and negative 0.9% in February. So the interest rate cycle is still a key catalyst for a sustained recovery. As noted, our surveys show most consumers still expect significant interest rate increases over the next year. These fears are overly pessimistic. Yeah, well, can you blame us? It's the media that we're consuming. That's why we're also pessimistic. People are always going to be pessimistic. That's why people build YouTube channels purely around doom, economic doom. Just fear, 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 fear. It gets the views. I've seen it. I can do a positive video with a positive title. No one will watch it. The algorithm won't put it out there. And that's just how it is. And that's why you need to make sure you have a variety of sources that you're getting information from. You don't want to be stuck in a social media bubble. There's like people that are just spruiking gold is the solution for everything. And I went down that path. I was watching all the gold bugs, all the silver bugs, and hearing all their arguments. But you've got to realize, what's the public, what's the popular demand for these minerals? Not the average Joe won't give a shit about it as an inflation hedge. Anyway, so you got to make sure you get a variety of sources when you're consuming this stuff. So let's check this out. Keep going here. Westpac's growth and inflation forecasts are consistent with the Reserve Bank going on hold following a 25 hike at the upcoming May board meeting. As households become progressively more confident with that outlook, rate rise fears will subside and confidence towards housing will likely build. Confidence in the outlook for prices has already improved markedly in the survey, with the Westpac Melbourne Institute Consumer House Price Expectations Index now 43% above its November low and marginally above long-run average reads. Comfort around the outlook for interest rates should also encourage investors. Indeed, we may see a significant shift in investor attitudes in coming months. Perceived risks around housing from higher interest rates and falling prices should ease. Meanwhile, other risk assets, especially equities, are starting to look riskier following recent turmoil in global capital markets, with the associated credit disruptions threatening to tip the US economy into recession. Interest rate moves are not the only consideration. Wider economic conditions are also important, particularly as they pertain to labor markets. Notably during the deep recessions of the early 80s and early 90s, and during the GFC, housing markets continued to weaken after interest rates went on hold. But labor markets were much weaker in those previous periods than they are expected to be over 23-24. While an economic slowdown is forecast to see the unemployment rate lift from 3.5% to 5% by the end of 2024, this is not expected to involve major rounds of job shedding. The main dynamic is instead expected to be around a slowdown in new hiring and a lift in labor supply. Employment is expected to rise just 50,000 over the period, insufficient to accommodate an increase in the labor force of around 260,000. The associated rise in unemployment comes more from new entrants to the labor market being unable to find a job rather than from job loss dynamics that can weigh more heavily on housing markets. Okay. Well, there's never going to be any discussion about reducing. I mean, new entrants is not just migrants over. It's also people starting out in their careers. That, I think, is going to be one of the disruptive factors of the AI, chat GPT things. You're going to see a lot of entry jobs and careers be automated. So, momentum is important, particularly as it shapes expectations. The mini rally in prices may still be quite fragile, but the momentum shift from negative to stable, possibly positive, is still important as it plays into expectations. Housing-related sentiment already looks to have become more supportive. While buyer sentiment is still very negative by historic standards, the shift in prices is clearly influencing consumers' dwelling price expectations. While expectations are not particularly bullish, they are no longer negative. This will further anchor prices, reinforcing stabilization. Our analysis of previous cycles indicates that once momentum shifts, a relapse back to the previous trend only really occurs when there is a sudden, unexpected shock to the system. The likeliest source of this shock is if central banks, including the Reserve Bank of Australia, were to extend their tightening cycles beyond mid-2023. That prospect is not our central forecast, given the clear easing in inflation we are seeing globally and the prospect for deteriorating growth in the advanced economies. And given the anchoring of expectations, it would take quite a substantial shock to trigger another run of material price declines. Certainly, a May rate hike would challenge expectations near term, but this is comfortably within the range of current expectations for most consumers. It is likely to require, at the very least, a sequence of rate hikes to dislodge expectations from here. So, conclusion. So the prices are to stabilize in 2023 with sustained gains unlikely until 2024. Westpac expects conditions to remain a little mixed near term, with prices holding flat over 23. Another major slide seems unlikely, although gains will be hard to sustain given interest rates and wider economic headwinds. A May rate hike is likely to check the improvement in housing-related sentiment near term. Some lift in on-market supply is also likely to test the depth of demand. A revised forecasts mean the correction now sees a peak to trough decline nationally of 10% rather than 16%. 10% rather than 16%. Is that the crash you've been waiting a decade for, guys? For calendar 23, the flat result compares to our previous forecast, which implied a further 7% decline, allowing for a slightly weaker than expected 22 result. A previous published calendar 23 forecast of negative 8% was on the basis of a 6% decline in calendar 22. The recovery is expected to move onto a firmer footing in 24, with interest rate cuts providing clearer support. Prices are now expected to lift 5% up from our previous forecast of plus 2%. Further rate cuts and an improving economic backdrop will see momentum carry into 25, although affordability is likely to constrain upside prospects. The main risks continue to center around inflation, particularly if disappointing progress on bringing inflation under control leads to the RBA to resume hiking rates later this year, but also if ongoing high inflation constrains the banks from easing policy in 24. Both developments would clearly undermine housing market improvements and could potentially lead to a reversal. Written by Bill Evans and Matthew Hassan, senior economists at Westpac. And if we have a look over here, here's their dwelling price forecast. So, for Sydney, I'm assuming this is 1%, and then 5% in 2024. Melbourne, negative 1% in 23, and 24, 5%. Brisbane, negative 1% in 23, then 6%. Perth, flat in 23, then 8%. And Australia-wide, flat in 23 and 5% in 2024. Well, let's have a bit of a talk about this one, guys. So there we go, everyone. Predictions of a stabilization in the housing market. Although there are a few caveats. What do you reckon? Would you at all be surprised? Is it just a dead cat bounce and their banks are just, completely wrong? We'll have to see, guys. As I've said, and I've made the argument many times, there are a lot of pillars supporting the housing market here in Australia. You've got supply constraints and just people selling. You've got supply constraints and ability to build houses. You've got labour costs. You've got government intervention and stimulus overheating the housing sector. You've got now shared equity rolling on. You've had a 100-year event, a 1 in 100-year event, and the banks just gave people a mortgage holiday. You've got the government changing the rules with regards to trading while insolvent. So there you have it, guys. Let me know your thoughts and opinions on this one. What do you reckon? Do you think they're on the money or not? Thanks for watching. Check out my other channels, HeiseBeam and Heise Does. I promise I'll get content up there eventually. I'm just flat out at the moment, guys. As always, if you want to support us, you can on YouTube or Patreon. You can use our referral links via Pocket Squares or call us if you need an architect. Take care, have a great day, and I will see you all next time. And I hope you had a nice and relaxing Anzac Day with your family. Take care.